Good morning and welcome to the Killik and Co market update. We've had more interest rate rises this week. Over in the US, we've had a rise of 0.75%, and that's the fourth consecutive rise of that level, taking their rate to 4%. Markets reacted negatively to this news, with the S&P 500 down over 2% on the day of the announcement. However, the 0.75% rate rise had been widely expected, so it's most likely the accompanying commentary that actually sent markets lower. Jerome Powell, the chairman of the Federal Reserve, said that we still have some way to go, and that incoming data since our last meeting suggested that the ultimate level of interest rates will likely be higher than previously expected. Here in the UK, we've also had a rate rise of 0.75%, taking our base rate to 3%. The Bank of England published its latest monetary policy report at the same time as its rate decision, and in this report there are always some interesting charts, so here we've got a couple that we want to have a look at. This one shows the bank's inflation expectations. Inflation is currently round about the 10% level, but the bank expects it to fall sharply from next year, potentially coming down to its 2% target rate by 2024. And this chart shows the key contributors to inflation for the UK, the US and the euro area. The orange bars on each chart show energy. So you can see that the chart on the right for the euro area shows that the euro area has the worst energy inflation of these three different areas, and that's because it's so dependent on Russia. The UK, over on the right, has more of a problem with services and other goods inflation, and that's potentially evidence of supply chain problems and lack of labour supply as a result of Brexit. And then finally in the middle we've got the US, and that's got much less energy inflation because the US is much more independent in terms of where it gets its energy from. It's still reporting season, and so far we've seen record profits from big oil companies, and this is a really big turnaround from 2020 when the oil price was really low due to COVID. In dollar terms, BP and Shell have made $8.2 and $9.5 billion respectively. US companies Chevron and ExxonMobil have made $11.2 and $19.7 billion, but by far the biggest winner is Saudi Aramco with over $40 billion of profit for the third quarter. Shares in Shell are now back up to where they were in 2012, when the oil price was last over $120 per barrel. The high profits that these companies have made have renewed calls for a windfall tax on the record profits of these oil companies. The UK budget is scheduled for the 17th of November, so we'll have to wait and see whether there will be any changes to the UK's windfall tax policy. And finally, last week we talked about some of the tech companies whose results had missed expectations. But this week I'd like to talk about a company whose results have beaten expectations. Keyence is a Japanese company and a global leader in industrial automation, with a particular focus on warehouse automation. This year, as wages have been rising around the world, there has been some speculation that perhaps companies would focus on automation rather than human capital as a way to get their wage bills down. And the latest results from Keyence suggest that this is starting to happen. In its results, Keyence reported a 36% year-on-year increase in earnings per share. Here's the 5-year share price chart, and you can see that spike at the end that happened after these latest results were published. So please do give us a call if you'd like to hear about Keyence in a bit more detail. Next week, we're coming to the end of corporate reporting season, so things are starting to calm down a little bit, but we have got results out from Walt Disney, Eon and National Grid. That's it from us. Enjoy the weekend, and we'll see you next Friday.